Senator Warren.
Thank you, Mr. Chairman, Ranking Member Crapo. I think it's clear we all agree that small lenders need access to the secondary market so they can write more mortgages and they can get funding that they need through advances from the federal home loan banks. And those advances play a critical role in promoting home ownership, particularly, I think a recent study showed, in rural areas. I think it's also clear that the market believes that the obligations of the federal home loan banks are implicitly guaranteed by the government, which is part of how these banks can raise funds at very low rates and then lend those funds at below market rates. Now, that may work if the funds are going to support home ownership in an underserved area like inner cities or in rural communities. But not every home loan bank advance goes to support home ownership, and every dollar that is used for another purpose is a dollar that's not available to finance the purchase of homes. One example of that is the multi-billion-dollar loan that Mr. Swanson's institution, the Home Loan Bank of Des Moines, has extended to a Sallie Mae subsidiary at an interest rate of about 1/3 of 1%. Now, as you all know, Sallie Mae is a private, not government company that made nearly $1 billion in profits last year, primarily by making high-rate private student loans, loans that have been documented to decrease home ownership. Now, I have no doubt that Sallie Mae subsidiary in question meets the legal eligibility requirements to be a member of the bank, but I have some concerns about the underlying policy about how mutuals work here. So first, I have a specific question about Sallie Mae, and that is, in past SEC filings, Sallie Mae has mentioned the credit facility from the Home Loan Bank of Des Moines, but it does not mention the credit facility in its most recent SEC filing. So, Mr. Swanson, does that mean that your bank has stopped lending to Sallie Mae?
Sallie Mae is a member of our bank through an insurance company that's a subsidiary or affiliate of it. We don't have any responsibility for their SEC reports.
So I wasn't asking that question. I was just asking a simple question. If you stopped lending, you had a multi-billion-dollar loan.
They're still a member of our bank, and they still have the ability to borrow, assuming that they provide federally guaranteed student loans as sufficient capital for their borrowings.
Well, so let me ask about that, about the activities that your bank supports and that it does not support. Is there a clear line between what it is that you can support and what you don't support?
There is. There are two parts to the question. One is who can be members, and Congress establishes that. And then the second point is when members borrow from us, what kind of collateral is eligible for them to pledge to us. And our primary source of collateral is home loans. We also take other forms of commercial real estate, including multifamily. And then we're permitted under our statute to take government-guaranteed securities. And in the height of the liquidity crisis and economic crisis, in fact, it was early in 2008, Congress, through a resolution in the House, actually asked the regulator of the Federal Home Loan Bank to determine whether...
I'm sorry, Mr. Swanson, but I'm really going to be limited on time. I know what the law is here. I just want to ask the question. In terms of the activities that you support, you're saying it would be for home loans and for student loans, but just so I can draw a clear line here, because we searched your website and we're trying to get clear on this, it would not be, for example, for other loans, to support other kinds of retail business, to support payday loans, to support tobacco stores, to support other kinds of activities. Is that right? You're telling me that's the clear line? Only student loans and real estate loans?
Our regulation and statute controls the collateral that we take for loans, and Congress further expanded the collateral for small institutions to include agricultural loans and small business loans. But that's pretty much the menu of collateral that we can take.
And so
very restrictive.
And so you will not lend in other areas and other business activities. Is that right?
We cannot lend on any other types of collateral.
So the reason I raise this is because I think it's important if we're talking about mutuals and and our investment, in effect, in the housing market, in mutuals, to know exactly what activities would or would not be covered by that, how much of it would go to housing and how much might be going to other things. I see that I'm out of time. I'm going to submit another question for the record, but I just want to say it's a question about whether or not mutuals will be able to compete in a highly concentrated industry. I think we're all aiming in the same direction, and that is that small banks have access, perhaps through a mutual structure, to be able to get money, but that has much higher administrative costs than a very concentrated banking industry where you've got an issuer who can lend to itself or to a small number of other issuers, where you've got issuers and when there's much more concentration, it's much easier to cut down on the costs. And so I'm just going to have a question about that, but I will submit it for the record. Thank you.